Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, April 22nd, 2016. In this video, this is a follow-up to the one I did a few days ago by request. I did a video on the sectors that stand out on the bullish side. And this video, I'm kicking myself for not following up sooner. If you watched that video in the beginning, I mentioned I wanted to hit on the most bearish sectors. If time was allotted at the end of the video, and I didn't have enough time. That video went longer than I thought or expected, so therefore I didn't get the bearish sectors in. And quite a few of those I'm kicking myself because in the last few days, a lot of the bearish technicals that I've noted in the sectors that I wanted to mention have some of those have played out. But again, I don't think in the bigger picture of things, by no means too much. There's some damage done today in the Qs. As I'm doing this video, it's about it's 11:20 Eastern time, so the markets have been trading for a little less than 2 hours. So we'll see how it closes. So there's still plenty of room on the downside for some of these sectors that I'll cover. If again that we follow through on the Qs. In other words, the dips have been being bought up over the last couple months. That's been the trend. And as I mentioned, the trading room today, let's see what happens. If this market sells off into the close, if this proves to be a trend day is when the markets continue to build on any gains or losses for that day. So in other words, today would be a trend day if we gap down, and if the markets continue to sell down and close below, close at their lows for the day, or at or near, then that's a trend day, and that would be quite bearish. Knife through the bulls' hearts. They're used to those, on the long side. Buying the dips lately has worked for the last few months. So you have to imagine there's dip buyers stepping in here. The Qs are down about 2% as I do this video. And, if they end up losing on that, then that strategy is no longer working, and you'll see quite possibly a trend reversal. And again, one day, I always say, I have a phrase, one day does not make a trend. A single day's price action doesn't make a trend, but damage can be done. As I mentioned, that the charts have been reflecting or indicating a correction for quite some time now, and that just hasn't played out. We had wedge breakdowns on the 60 minutes. We back tested at higher levels. Markets kind of really held up. But as I mentioned yesterday, that doesn't mean that it's not going to fall. It's still my expectation that we're going to get a correction in the broad market. And we'll see if today is the catalyst that we needed again. So let's see how today finishes. All right, enough on that. Let's jump into the charts. And excuse me. This is the same list I've had on my scratch pad from the other day, and in no particular order I'll go through these. This is the biotech ETF, XBI. I'll look at a few of these real quick. I mentioned in the trading room, gosh, it's been almost a month now, shorting the biotechs via LABU, which I hopefully plan to hold that as a long-term trade. The biotechs are actually holding up. So this is one sector, there was no point in rushing this video out the other day because the biotechs are still up near their highs. This is XBI, as I mentioned here, long-term uptrend line, the primary uptrend line, which was broken. And on this weekly chart, we appear to be flagging a bear flag, and we're at the top of that flag now, and we're also at a pretty solid resistance level. Let's look at the daily chart here. On XBI, you can see I have this line around 57.70. There were a few reaction highs above that recently. Fibonacci levels, everything else in here. It shows even better on IBB, which is a NASDAQ biotech ETF. If you look at this red line, you see numerous reactions. If you look where my cursor is, that's can't make that pop-up box go away, but you see a reaction there, a cluster of reactions there. That was a consolidation area and then a thrust out of there. We have several reactions back here. So again, this is a well-defined, that red line is a well-defined resistance level, which was the reasoning for my short entry, which was back here at that point. So, I went profitable and then flat to slightly underwater, and I believe that trade is slightly positive now. But again, there's one that, in my opinion, still offers an objective short entry because you can short here at resistance with a stop not too far above. If the biotechs power on up through here by quite a bit, take out the recent highs. And I mentioned this to somebody in a private message today. As far as my trade, they had also shorted when I posted shorting in the blog a few weeks back. The biotechs LABU, they did the same and asked where my stops would be. And it would be somewhere. I don't have a hard stop on that. I don't want to see these recent highs get taken out. However, I also trade always keeping the broad markets in mind. So let me give you an example here. We've seen some technical damage on the Qs today so far. How we close will be more important. Intraday dips can be bought up. So let's say the Qs, follow through on the downside. I pointed out some support levels in the SPY and IWM, which so far following suit, they opened up positive today. They started trading up and then finally realized, hey, the Qs have been the market leader. They're getting hit hard. We're going to have to follow their lead, and so they've since moved lower. But where I'm going with this is, let's just say fast forward a few days. Today's Friday, so let's say next week the biotechs pop and they take out these recent highs, but I see the broad markets continuing lower, breaking support, building to that bearish case. Not only will I not stop out, I'll probably add to this trade, because one thing I can all but assure you is that if the broad markets drop, and I'm talking 5% plus, the biotechs are going to go down with them. The biotechs are, a big part of the NASDAQ 100 especially. It's very heavy in biotechs, quite a few in there. And that's the, in the NASDAQ itself, this is the IBB, is the iShares NASDAQ Biotechnology Index ETF fund. So these, I believe, are all NASDAQ biotechs. And I look at XBI a lot, because if you're trading LABU or LABD, that tracks this index, the Spider's S&P Biotech ETF. So enough on that. There's my thoughts. There's that flag as viewed on the daily chart. And again, on the weekly chart, we can see flags on XBI, IBB, there's bear flag, and PBE is the other one. So PBE, has just tried to regain this trend line, and it's just barely above it. If it holds, bullish, but if it falls back down, it's only slightly above that trend line. So again, if the sector moves lower, the other two move lower, this one's going to go with it. All right, enough on the biotech. So that's that. If you want to wait for a little more confirmation in the markets, you can certainly do that. And for the longer term picture, for long-term swing traders or those that don't like to get ahead of breakdowns like I often do, you can wait to see these weekly bear flags break. That would be another sell signal, and that would project, just take the measurement. You take the flagpole, which is right here, measure it down to the bottom of the flag, and then add that to the top, the highest point of the flag, and that gives you an idea. And you can see here I had a horizontal line right there around 211 on IBB, and that would be, even though the flag measures a little bit below that, that would be an ideal price target for me. All right, let's move on. Take a look at the next ones. We did XBI, LABU. On a closely related note is the XLV, which is a Spider Select Healthcare Sector ETF. Now, obviously, there's, the healthcare ETF. They may even own some biotechs in there, and if not, it's a closely related industry, obviously. So, you can take a look at the individual holdings, and I want to point that out, because if you short one and you do have a lot of biotechs in here, you're going to have overlap in your portfolio, and you can see the charts are similar. XLV went on that huge tear, off the 2011 lows. Similar to the biotechs, broke that long-term trend line, primary uptrend line, flagged, broke downs, flagging again. So there's your cue for a short. And it's these divergent tops I look at. If I'm lining up to the highs right here, you can see down below, just like the biotechs had, negative divergences on the PPO, the RSI. These are the things that tell me, when I see these on a weekly chart, I'm looking for a primary, usually a primary trend reversal. And, did we get enough? Maybe. We've had already a 20+% correction, so technically a bear market. But look at the scope of this move. Let's just put up a Fibonacci retracement, and this is why I'm saying there could easily be a lot more downside. That was a monstrous bull market in XLV off those lows. And so far, as ugly as a 20+% drop is, we didn't even come down to a 38% Fibonacci retracement. This was just that sort of mini crash on that day. Very few trades occurred there, so I disregard that candlestick. And this is really about as far down as prices, in normal trading went. So that's quite a bit more downside, in my opinion, in the coming months there on XLV. XLB. That is the basic materials sector. I haven't updated this chart. Let's see, I must have had something on the daily chart here. Nope, you know what? I had a question mark by this one on my notepad. It's just quite extended. Oh yeah, here's what I've seen. I didn't mark it here. We have this divergent high. This one, I'm sorry. I'm overall bullish on a lot of things, commodity related, and you're going to get a lot of that in the basic materials. Longer term bullish, but right now I think things have gotten ahead of themselves in a lot of these sectors. And so if you look at XLB, I guess I hadn't drawn that out, at least not on this board. You can see this divergent high. That's yet to be confirmed. I'd like to see. Let me throw up a MACD here. Put that back and put a MACD out. Okay, it's similar to the PPO I just took off. MACD is down here below. And this is what I call potential divergence. Once this blue line, the MACD line, crosses below that signal line, that's when at least my book, I call it confirmed divergence. I want to see this MACD make a bearish crossover, making a lower high right here and turn down. I fully expect that to happen. You can see we're quite overbought here. Here's double consecutive overbought readings above that red line, which is a 70 level on the RSI. Divergent high, big rising wedge, nice, pretty clear defined uptrend line. So here's one that I would say that I'm near term and even intermediate term bearish on, but longer term bullish. So what I could see this one doing, for example, I don't have this chart all marked up, but there's a support level there. There's a couple of others there. But if this wedge breaks down, I'd be looking for a move down to at least that 44-ish area. So if nothing else, one that might on face value, you see this line here, that was a very well-defined resistance level before. Former support back here, reaction high, breakout. This, to me, will be a bull trap, a false breakout, most likely. That's probably going to fail. And if and when it does, as I often say, fewer things in trading are more powerful than a failed breakout, because just the dynamics of the whole thing. You have bullish traders that see that breakout, they go long, and then if that breakout fails within a few days, they have to turn around and reposition. So you see the longs cover, or sell, I'm sorry, then the shorts will pile in, those that have the, everybody sees different things. I see a bearish chart here. I recognize the breakout, and that's why I'm not short this sector now. But on a downside move back below this level, you will have broken below both this bearish rising wedge as well as that former resistance, now support level at around, call it 46.30. Well, it says 46.37 there, so I'd actually could take it down a little lower, to be honest with you. I clipped those recent reaction highs, so 46.12 minus that 12 cents to be safe for a margin of error. So break below 46 will have clearly taken you below this uptrend line / wedge and down under that support level. And it looks good down to at least that level, possibly more if things get real ugly. Maybe we even come back to backtest this recently broken downtrend line at lower levels, and that would take us all the way down by the time it got there to at least the 42 level. Again, depends how things play out. So that's one that near term, at least the very least, be taking some off the table or tightening up stops if long. I already did XLV, didn't I? Yes, I did. XLU. This is the one I was kicking myself at. Up here, I was going to post this, considering posting it as a short trade idea. We had this nice double top high. When you have a strong reaction high after a big rally, and that was a major top in the utilities, that then becomes significant resistance. Those reaction highs are always watched by traders. And when we got there, we had divergence in place. It's not drawn out on this chart, but we had negative divergence right there. We had extreme overbought readings. We had overbought here, again overbought. So these are consecutive readings. We could probably have drawn a nice uptrend line there, cutting out that little spike right there. And and so even, ideally you could have shorted right there with a stop above. Now, I didn't do it because the utilities, that's sort of what I'm favoring in this environment are, high yielding stocks, and utilities are defensive issues. But that was already priced in. They already had a heck of a run. So, the utilities from that point, that was about almost a 20% run just from the December lows too much, too fast, and you can see what happened. So they moved down pretty sharply. So at this point, I would not, let me just make it clear. I just had it on my list. I probably shouldn't even have touched on it today. I wouldn't be shorting those here, especially after that big drop. They're coming up on support. There's support there. Ultimately, they might drift back down to this level here. But, you know, if you short a dividend-paying stock, you pay that dividend. So that's a 3.25% yield. Might take a while to get there. So just not enough meat on the bone for that trade in my book. I'm going to wrap this video up here. There might be some other sectors. I'm just going off the list I had the other day, so I'll take a look at some other sectors. You know what? I might not have covered XLK. I'll get to that in a second. But you know, for example, in the basic materials, as I mentioned with the pullback, there's a lot of stocks that have had some great run-ups. You know, so several of which we've traded on the site. Quite a few, and had nice gains. But now you look and you see what's going on. Here's AA, Alcoa Aluminum, and again, I'm not going to go into individual stocks in this beyond this one in this video. But you can see if this stock starts to roll over here, we'll have confirmed divergence on the MACD, the RSI as well. See between this line, prices making a higher high from this point after breaking down below this rising price channel. So prices, you know, went through there, and this again looks like a breakout. This obviously it's in the same sector. It's a basic material stock, but you can see this trading range here. I don't know. I'll draw it out. Sometimes my eyes might see, you know, pick up on different patterns and cues, but I see a lot of activity in this area here. A lot of trades. We broke down. We went above it, but for the most part, and that's reflected here. See this long volume at price histogram bar? That just shows a lot of trades have occurred. This has been a battle zone between bulls and bears, and you get below it, prices move sharply lower, and we dropped out of there. See the impulsive move, impulsive selling down into it. A fake breakout here, false breakout, which was rejected at that downtrend line. Then we broke out of the downtrend line, but we failed to get out of the range. And this was a false breakout right there above a downtrend line. Boom, impulsive selling. That's what happens during a bull trap or failed breakout. And so now what happened is, you know, we've consolidated for months here. Very powerful. You know, normally I might say, wow, great base to break out of, and maybe so, but right now I'm seeing divergence. The sector shows that divergence, and I'm leaning towards this being a failed breakout. So, you know, on that one, again, just like the sector, you could short it here with a stop above the recent highs. There's actually a reaction high and that would be an ultimate, you know, stop above, a little bit above 1115. And you know, if you zoomed in, this line will show better on a 60-minute chart. You can draw a near-term uptrend line. Let's do that here. Let's just go to the 60-minute chart. If you wanted to short AA, there's your near-term uptrend line. So that would give you an objective entry. No reason to jump the gun right there. Just wait for a breakdown of that trend line. And you know, the divergence is drawn here. I can draw from this peak to this peak. But either way, so there's a possible pullback trade. And again, I can't recall. So looking at my notepad, here it is, XLK. I must not have covered this one. So there's XLK. This was on my list to do a few days ago. You can see the divergent high. Price is making a slightly higher high here. Without making a higher high on the RSI, it was about an equal high, and a lower high on the MACD. So there's your negative divergence. Had this nice uptrend line which broke down, and just like the broad market, I mean, this was frustrating for a lot of shorts or technical traders. You know, we saw these uptrend lines just like on the broad markets. Prices broke down, but what did they do? They traded sideways for a few months. So I know at least on the board there was a lot of, you know, frustration. This market will never go down. It's bulletproof. We're going to go to new highs because, you know, we broke down, but the bears can't take it lower. Well, that's not the case. It's just, you know, it was a battleground. We didn't go lower up until recently, and now we've broken down from that range, just like on the broad market. So that's a breakdown. That is a shorting up. I still think it's objective. You can put a stop, like on XLK, for example. You have the gap. Today's gap, that would around, say, 44, a little over 44, 44.10 maybe, could be your stop in case we want to come back. A tighter stop would be at the bottom of this range or just above it. Remember, if this is support, former support, which is now resistance, that level right there, I also have a horizontal line that's at 43.80, call it. I don't put my stop at 43.80 because the back test will hit your stop. You want to give it a little room above. And ideally, if you're swing trading, because my target for this, minimum target would be on XLK, and I'm just doing this quickly, but I can see a nice gap here, some reactions. This line here, so 42.60, call it. So calculate your RR, see if that's worth it. You know, you want to get a 3-to-1 or better RR, ideally, risk-reward ratio. So see if that will allow for a move there. And if you think we're going even lower, maybe this is the beginning of the next major leg down in the markets, which is quite a possibility. We'll just have to see how the charts shape up going forward. But if that's the case, then yeah, you allow for wider stop. And if you prefer tight stops, and just set a stop over today's highs or just slightly above today's highs, or even, like I said, that bottom of that trading range there on XLK. That's the technology ETF. And there it is from a long-term perspective. And this is why, you know, I've not moved off my bearish, longer-term bearish outlook for the markets despite the recent rally and resiliency, you know, with the market refusing to roll over. You know, this chart speaks volumes to me. There's your primary uptrend line, this white line. It terminated in this rising wedge type pattern. It's not drawn all the way. We actually pushed up to this point, was a little higher high right there. So this divergence really extends from all the way back here, making a series of higher highs while making a series of lower lows on the PPO and the RSI. And those are multi-month, almost year-long divergences. This tells me we're likely to get more than this little correction, if you want to call it, which is really all that is. I think over time, XLK heads down to, don't hold me to these targets right now, but that would be an ideal target there. And it actually, you know, just lines up well with that reaction from that meltdown day we had, that mini crash. And there's some horizontal support there, so around 31, 33. And, you know, in technology, you can get those leverage ETFs. That's what I love to do, and that's how I tend to position if I'm trading a sector. If I'm bearish on the sector, I'll short the 2 or 3 time long version ETF to capture both the decay. It does a couple things. I can use less capital, although some brokers, they have a pretty high margin requirement on those things, you know. But for the most part, you can short a third of what you can short in XLK and have the same net exposure. So that's another idea. Okay, guys, I'll wrap it up here, and like I said, I'll put some. I'll work on getting some individual trade ideas, but I wanted to get these sectors out there. You know, and if I decide to make any official trade ideas, I will. Probably should cover XLF. XLF, that FAS trade was stopped out today. Admittedly, my stops were probably a little tight. I thought a reversal was imminent when I added that short yesterday. So we just got clipped on that stop today, and I think we're trading above that level. See, this is the open. This is a 1 minute chart. So we opened, we ramped up. My stop was, I don't know, somewhere around here. We just got it clipped, and that's fine. I'll probably add this one back. There's a nice little flagging action there, that channel. So what I expect today, we also have resistance. This is just a 1 minute chart. You can see the reactions back here, quite a few reaction there. So, you know, in fact, I think the XLF or FAS, which is a 3 time bullish, which was my proxy, preferred trading proxy, is still a good short right here. You could put a stop not too far above there. You know, if you went in here, you might as well just give a stop over today's highs. But there's 3 levels. These are just for intraday traders or anybody really trying to sharpen an entry point on this. Go ahead. You can wait for a breakdown of this flag, which I think is going to happen soon, probably by the time you watch this video. There's your next resistance level if you want a very tight stop, or a little more liberal, put it over the highs. And you could do the same thing on FAS. Like I said, I like to use, especially longer term, the charts of the one-time ETF, but there's FAS. So if you're using a 1 minute chart, you're not going to have any decay in there, at least intraday. You know, the decay occurs based on the closing values on these ETFs. So you could just, you know, list the same levels there. All right, I will wrap it up here this time for real. Okay, if you guys have any questions, shoot me a private message or reach out to me in the trading room. This has been Randy Finney with the Right Side of the Chart. Hope you enjoyed.